Hi, I am Syed from Blockwall, and in this panel on stablecoins, we are going to talk about how stablecoins could be useful for cross-border transactions, for cash management, and much more. And joining us today, we have Dorothea from MasterCard, Casper from Blue, Alex from AllUnity, and Chris from Tradius.
Thank you.
Thanks for joining us, guys. And intro, yeah. Should we start with a round of introductions?
Sure, happy to start. Fantastic. Hi, I'm Dorothea. I'm Vice President for the Global Partnerships team, looking after the go-to-market strategy for digital assets for MasterCard globally. Basically my team is managing also all the account relationships with the exchanges, wallets, and on-ramps, such as Binance, Coinbase, Crypto.com, and so on.
Yeah, hi everyone. My name is Chris. I'm the founder of Tradius. Tradius is a fully regulated securities trading bank out of Frankfurt. We're focused on market making for digital assets, primarily on the OTC side, enabling neobanks, neo-brokers, and traditional banks to offer crypto to their end clients. We also have a tokenization arm where we work, for instance, with CashLink and help bring assets on chain with a heavy focus then on providing liquid secondary markets for those assets as well. And we'll also do some exchange market making.
Hi everyone, my name's Casper. I'm the CEO and co-founder of Blue. So we are an on-chain credit-first digital bank in Latin America. Today we're live in Mexico with a credit card, as well as cash advances, so credit products. But the aspiration is to have a full suite of credit and debit products throughout Latin America, eventually developing countries, and then even longer globally.
Hi, my name is Alex. I'm CEO of AllUnity. AllUnity is the first German BaFin-regulated stablecoin, e-money token. AllUnity belongs to DWS Galaxy and Flow Traders, and our clear path is to be one of the European cornerstones of payments in the future.
Great, thanks, guys. One question I would like to ask all of you is that why should businesses care about stablecoins? Why should they pay attention to it?
Do you want me to? Okay, maybe we start off with a couple of statistics, which I think have been quoted before, but I think it frames the conversations quite well. So in 2024, the stablecoin transaction volume was around 27.6 billion. I'm coming where it's coming from in a second. I think another interesting one is, especially in terms of payments or B2B payments, is that when you have the average cost of a transaction in terms of ACH wire is between 5 to 6%, depending on the research report you're looking at. When you use stablecoins, you can go down, depending on how much transactions are happening on which blockchain, you can go to 0.01 cent. I think it was on Base. I think that says it all. So companies like MasterCard, of course, do pay attention, not just because of the volume, but also because of the technology benefits that we see. We have been looking at the space for probably around 7-8 years now, building a product team on the one hand side. Now with my team, we have a business development team and an account management team. And so why? I just explained in terms of numbers why, but obviously it all started also on the MasterCard side with volume on our network, to be fair. We saw on the on-ramping side, so what we call acquiring, the on-ramping side, and consumers like myself using MasterCards or wanting to use MasterCards to basically buy digital assets. Well, we have talked already before quite a lot about a trading use case. So the demand was there. Okay. So we paid attention. We want to serve our customers. We basically want to make sure that they have the choice to use MasterCard to basically buy the assets they want to. And then with that demand on the on-ramping side also came the off-ramping demand at some point. So we had customers such as Gemini, Binance, Kraken, OKX coming up to us asking how do we get the asset out of the platform in an easy way again. So we, in a moment, and we enabled that. Yeah. So it was a demand as well as technology question, I think benefit that we saw, and that's where we came from. We started to pay attention.
When I pointed at him, I think he's also your customer.
Correct.
We are
Microsoft. Sorry. Of course, I know you're a customer in Mexico. And exactly what you're doing with the card is basically part of our off-ramping solution suite that we're offering, allowing customers like you're doing in Mexico to use stablecoins or digital assets, doesn't matter, as a funding source. to be able to pay at the point of sale. So I, Dorothea, can go and pay for my Starbucks coffee with Bitcoin, Ethereum, USDC, whatever I want. Yeah, demand, technology benefits
Makes
for
sense.
infrastructure.
Chris, would you like to?
Yeah, I think looking at it from a maybe financial markets perspective, obviously blockchain, I think we all know by now the efficiencies that can be leveraged via the technology. But the limitation we're seeing at the moment definitely is on the fiat leg side, right? So I think when you talk about why are stablecoins important and sort of how we look at it as a market maker and from a trading perspective is that we really hope that stablecoins will not only drive operational efficiency, which is definitely an aspect, and obviously bringing down costs as well on the settlement side, but really also the reduction of risk, right? And I think that's a topic that sometimes is overlooked. And I think increasing settlement speed, I think an earlier panel discussed moving from T+2 to T+1, but really having the optionality via stable coins to settle faster and also settle globally, right? I think when you look at the digital assets market, it's a very international market, it's a global market, right? So removing those sort of barriers that borders have naturally and historically created is a massive aspect for us, and I think for a lot of market participants. So yeah, that's why I think everybody should care about stablecoins.
I mean, I agree with you guys with what you guys have already said. So I think over time, the use cases will also evolve as more and more people come on chain, as more parts of the infrastructure come on chain. For instance, like a lot of settlement for these card networks is still in fiat. If it wasn't crypto, there would be new use cases that we could open up. Also on the merchant side, a lot of them still carry fiat. They want fiat that MasterCard's paying them. And so when they also are dealing in crypto, new use cases come about again. And so I think it's like an evolution over time. But one obvious unlock is like pre-funding, so just holding collateral with a correspondent bank if you're doing cross-border payments, or with the card networks if you're settling with them every day, or on the weekends if you're selling them again every day. There's quite a bit more capital you have tied up relative to the amount of capital you're actually moving that stablecoins will solve, and a lot of that's just happening because it's T+2 and because there's this lag in settlement. So now you're building solutions around these problems that eventually won't need to be there. And then when you open that up, more and more stuff opens up and more use cases open up. But that is also restricting certain growth and certain use cases in the infrastructure. So I think things will evolve over time. It already has. And so it's important to sort of have reversibility and also understand like where are we in the cycle, or where are we in the full trajectory of getting everything ultimately tokenized or in stablecoins, or however you want to look at it.
Think about what we can add to that. I think that with the regulation, or no, let's start differently. A lot of people, when they complain about the, let's say, before structure, before MiCA, before blockchain, before this, why is this so complicated? Why is there this whole post-trade cycle in the classical financial industry, or payments, or what have you? And I tend to say, guys, if you would have been in the same place, you would have come probably to the same complex solution, because that was the only solution that was viable back in the time. Just because you now have a technically evolving infrastructure that allows you to actually circumvent a lot of stuff or exit out, doesn't mean that beforehand it was stupid. No, it was the only means how to tackle it beforehand. But now, based on the technology, there was a possibility to solve and address all these issues, but the regulatory framework was missing. And that means now you have the regulatory framework, and as we see it, also other regulatory frameworks globally are leaning towards MiCA, or are pretty comparable in a lot of aspects, called that way. And that's the fundamental first step into an interoperability, quote unquote, so that you can use it really for really cross-border payments. I mean cross-border payments, not Germany to France, it's like Europe to Latin America, it's Asia to the US. This is what I mean with that one. And with that, you can attack the classical, let's say, monopolies in the financial infrastructure, because building a clearinghouse 10 years back would have been impossible to finance. Now it's pretty easy, actually. And also, to get into that, you have everything. You have the framework, you have the stablecoins, you have the technology. Everything is there. And as you said, and Michael said it before, this is just the first step. It's the lifeblood in a sense. But then comes data, then comes status, then comes approval, then comes identity. So all of a sudden, you can really build yourself upwards in this value chain and add more and more and more to the transaction of the payment. And so this is just a mere start, and the possibilities are really, really, really big for everybody.
It's really interesting what you said about cross-border payments. I wanted to ask you a follow-up on that. So let's say somebody from Germany wants to send money to Nigeria. So it's clear from the discussion today that stablecoins are increasing the velocity of moving the capital and reducing the cost of moving it. So how are stablecoins being able to do this thing?
Yeah, yes and no. I think that interesting is in a lot of conversations that you have on panels. Yeah, they say, okay, this changes everything. You don't need to look for the cash leg anymore. This is not true. And I think so far, yes, naturally with you guys, that's a different story. But I can send instantly my stablecoin to Australia. But if somebody in Australia wants to off-ramp, then the money is still in Europe. And then the money takes 2 days to get there. And ideally, what we hear from the corporates don't want to care for foreign currencies anymore. So they want to send euro, and they want the issuer or the market participant or the service provider or whoever to make sure that Australian dollar actually arrives there. So technically, you would say, up in the air, miraculously, the stablecoin converts from euro into Australian dollar. No, that doesn't work because you cannot short mint. The reserves are still in Europe. To mint it, you would have to have the reserves in Australia. Or you do it in Europe and then you send an Australian dollar stablecoin, but then you cannot off-ramp in Australia because the reserves are still in Europe.
Right.
So, and whenever you have that discussion, it is answered with, yeah, but in the crypto industry, yes, for crypto trading, that's true. But we're not talking crypto trading here. We're talking real economy corporates paying subsidiaries, customers, whatever relation they have in some other jurisdiction. And that has not been solved yet. So I can send instantaneously a stablecoin wherever I want in the world. I can convert it, FX it, I can all do this, but only if the reserve is in the same place. Because all the jurisdictions have defined that whenever you issue a stablecoin, the reserves has to be denominated in the local currency and held in the local location. And that is something that has not been fully solved yet. And that means for the cash leg, you would have to go back to the classical system, our corresponding banking system, central banks, service providers, what have you. And that means you're falling short of the full potential. That doesn't mean we shouldn't start.
Yep.
Just means we are not there yet.
Yeah, I agree. And that's what we see as well. It's like the last mile distribution sometimes is a bit of an issue. We do solve for that on our side with the card payments. So we are being used as last mile distribution partners. Essentially, we do allow customers to spend at the point of sale, but to be fair, what is actually happening is there's a real-time exchange in the background. No? So we basically, there's typically a VASP or CASP exchange involved, and they're enabling a real-time exchange in the background into fiat still, because also the merchants typically do not accept digital assets and stablecoins. This is depending on where you are across the world. This is slightly changing, sometimes faster, sometimes slower. I think very interesting news I've read about 3 weeks ago in Switzerland is that Spar, grocery retailer, started to accept digital assets as a means of payment, which I found very interesting in Europe, because Europe is typically a very well-functioning market. We see this more and more developing markets, but it is also coming on the other side. But what you're saying is absolutely true. We see that as well. There's a bit... The part for moving from A to B is fast, but then like converting it and bringing it back into the local system, that is still not solved for yet. So that still needs to be worked on.
I'm glad you mentioned this thing. I'm just wondering, in addition to these hurdles, what are other things which are preventing from the big corporations, the big companies, from going full steam ahead with the stable coins? And that's a question for all of you.
It is how it's treated on the balance. Because crypto assets, unfortunately, and as Micah was the first one to come out of the door, a lot of other jurisdictions leaning towards us, especially South Korea and Japan, because they're anyway very close from the regulatory framework. Crypto asset as a word is in the framework. And as crypto asset word is in the framework, the compliance head says this is a crypto asset. Now, a crypto asset has to be secured by 1,250% for a financial institution. Now, if it is just a financial instrument, then it would be secured by 20%, which is also a lot, especially given as it has to be reserved with 100% underlying anyway. So a classical banking instrument is like 8%, 20%, depending on what you have. We have, depending on where you are, 1,250% plus 100% reserve, which is ridiculous. Yeah, and for corporates, naturally, that are not financial institutions, they don't have to put that equity underlying, sure, because they're not a financial institution. But the corporates tell us, hey, I want to use my classical banking relation. I don't want to change the banking relation that I built up over the last 50 years just to be able to pay with stablecoins. So they go to their house bank has to offer them a wallet, and then the house bank says, 1,250%, forget about it, I won't do it. So these are the very, very practical things. It's not like, oh my God, we need to change the world. No. Talk about and define how you have to treat it on your balance.
So risk management.
Pardon?
Risk management.
Yeah. That's it. Very, very, very simple. And all the big, the Wirtschaftsprüfer, so the audit companies, they also don't know how to treat it because that is still a grayish zone. And when are the audit companies in? For 25. They come 26, 27. So if you want to use stablecoins now, the problem will come 26, 27 when you do your audit. And then, what does the compliance guys say now? Okay, stay away from it.
Okay, so it's a majority of the compliance and the security practices. That's the
They don't know. They have to treat it as the worst outcome because it's not really settled yet. Everybody knows that they have to touch it once again because it's ridiculous, but it has not been touched yet. So very often it's not these, we don't have to change the MiCA law. That's not the point. Just clarify that this is a 100% reserved asset and it's not crypto. Period. It's cash equivalent. And if that sentence would pop up somewhere, then everybody would be happy. It's relatively simple.
What are some other problems that you see that needs to be solved?
I think another problem that we see is that there's a bit of a lack of a coordinated effort from the entire industry, or like looking at the financial system again, from all financial markets participants to move to new system, right? So what you're seeing is, I think, if you're a global entity or company, the first step is always, okay, let's look at our internal processes. Let's look how stablecoins or tokenized money market funds can help move us things around within our company. And that makes a lot of sense because you're in control. You own let's say, your own ecosystem, right? And you can make that happen, right? I think for, let's look at traditional financial assets, bonds, equities, ETFs, etc., to say, okay, we're going to trade them versus stablecoins and move, let's say, all the downstream processes to a blockchain-only world. It would really take a coordinated effort by all market participants, all banks, for instance, funds, etc., to say, these are the common standards we want to agree on, right? These are the security standards we want to have. These are, let's say, the list of stable coins we see as relevant stable coins we want to trade in and then quote our products in. And I don't see that happening right now. I see a lot of efforts within those large institutions and companies to do something, right? But I don't really see that coordinated effort from market participants to jointly move in one direction. And I think that's why sort of the adoption in that regard has taken a lot longer than anticipated. It's different with crypto assets. Why? Because the only way to get crypto assets is having blockchain technology, right? So it's almost a necessity here. But I think for all other asset classes where you have traditional rails, even if they're more inefficient, even if they're more costly, the issue I'm still seeing is that there's no real, let's say, industry-wide coordinated effort to really move the entire system over. And I think that really needs to happen.
Casper?
I would just add to that maybe technology too. Like there's a lot to build on the technology side, and you're taking traditional banks that don't have the technology and then trying to plug it in, or even just change something. Like, for instance, before we pivoted, we were at one point building a Bloomberg terminal for banks that could also be with crypto and tokenized assets. And yeah, there's just like, there's no tokens in their infrastructure or any of the software that they're using. And to get that through all the bureaucracy of a bank is almost impossible. And so, yeah, I would say that as well. And then also privacy, which we touched on, right? Like, these are not private transactions. We haven't put our entire credit card portfolio on chain because of privacy. Like, not necessarily regulatory concerns, but more so competitive concerns. Like, I'm not sure I want my competitor to know how many transactions we're processing per day, or how big the portfolio is, or how many new users we're getting per day, or where these users are coming from. So even if it's not fully like someone had said before, it's like pseudo-anonymous, right? Like, you don't know the identity of the person, but you can It's still tricky because you can still see how many wallets are in there, how many assets are in there, and what you're doing with those assets eventually, right? If you're borrowing against them, and the interest rates and things like that. So I think there's a lot of problems that still need to be solved. Some have already been solved. And probably regulation is like the key driver here, because people at the banks are sort of looking at the regulators and they're operating in a certain way. And so to get coordination, you probably need regulation and comfort. But long story short, I think there's a lot of things that still need to happen. But we've also come a really, really long way. So I think it's certainly moving quite aggressively. Yeah.
Excellent. Chris, a follow-up on that. Do you also see similar issues in real-time instant settlement in trading?
Yeah, absolutely. I think that's one thing where people get really excited about and say, okay, we can settle everything instantly, right? For us as a market maker, I can tell you that is actually not what we're looking forward to, because we need leverage in the system, right?
Yeah.
And if I'm quoting a bid and offer quotes, right, on both sides, and I need to settle every trade instantly, that means I need to hold both sides of the assets at all times, right? Just in case there's a trade happening, right? And what makes it even worse and more complicated is that we don't have, let's say, a fully scaled up prime brokerage model on the crypto side yet, right? So you don't have the large banks that extend leverage to the same extent like they do in the traditional financial markets, right? So I think when we talk to our clients as well, we have certain booking cuts, right? So we trade 24/7. Then at a certain point, there's a booking cut. We look at the net amounts that need to be settled on the coin and on the cash side, right? And then, of course, once that process is initiated, stablecoins will be a great accelerator, because the entire settlement process then, the time of that can be heavily reduced, right? But I think we wouldn't want to move away from having certain settlement cycles and booking cuts, because settling everything instantly actually, I think, would make the business we're in, at least, and all other trading houses and market makers extremely costly, right? More costly than it probably is today. That's where I think there's still certain, to your point, very practical limitations, even though the technology could be obviously used for this, right? And in other transaction systems, this might make sense, but when you have 100,000 of trades a day, right? Settling everything instantly, also from a cost perspective, is probably not what you want to do.
Maybe I can add an aspect from the payment side actually to this one, because for me this is actually quite exciting, because I used to cover also the fintech customers on the MasterCard side, and now on the crypto customers. So they have one massive pain point, typically with MasterCard, it's called collateral, because the settlement cycles, they're not real-time, and they only happen during banking hours. So they need to post collateral for over weekends, bank holidays, and so on and so forth. And if you do not have an investment grade, this can be quite significant and very painful. So with stablecoins, actually, to be fair, in combination also with SEPA Instant, we are actually increasing those settlement cycles and enabling our customers to reduce that collateral, which for my customers is actually very beneficial.
Yeah, that makes a lot of sense.
Yeah.
Great. I have a question for you, Alex, and it's very interesting for me. So the biggest stablecoin issuers, we have Tether, we have Circle. Both of these stablecoins are denominated in USD. Why do we need a Euro stablecoin? Why can't we just continue using the USD denominated stablecoins?
I think we have to look at where stablecoins are coming from. Yeah, they're coming from, and I don't want to go too back or too deep into the past, but original USDT was coming from moving funds between Chinese financial market institutions, and then was used as margin currency in the first Asian derivatives exchange trading sites. Yeah, BTC, USDT, perps and stuff on Binance and what have you. So as the main product is still the perp being traded on the crypto side, margin currency is USDT or USDC. These are Asian exchanges. You see very little derivatives volume in the US, more than in Europe. There you see no volume at all. So it is natural that this market has been developed in the US, with the US dollar in Asia. So that's the first thing. Before MiCA, there was no benefit for a Euro stablecoin, because a Euro stablecoin, although around 30% of the global crypto trading volume is coming from Europe, still there's no benefit in having a Euro stablecoin. Now MiCA, a MiCA-issued stablecoin has a different risk profile, so that changed a bit, yeah, let's call it. But beforehand, there was no necessity to have one. Now we can go into the details how Tether is developing. It's more developing into banking the unbanked than actually derivatives trading, so it's a different animal. And Circle is really focusing on the US, and don't want to play bad here on Circle, but the focus on the US side is very clear. Now, the market for euro stablecoins is not a BTC euro perp on Binance. That's not the market. The market is tokenizing the 600 billion euro, fiat euro, that are transferred daily between the European Union and the outside world into Europe. You have a mix of currencies today, which is central bank money, deposit money, commercial bank money, and e-money. And what we're currently doing is we're tokenizing these. CDBC's deposit token, commercial bank token, and e-money token, stablecoins, is just the tokenized version of e-money, which is also a ridiculous discussion when we talk about, that nobody needs stablecoins. Nobody would argue against using PayPal. So why do you argue against using tokenized PayPal? But anyway, so there is a market where a certain portion of that 600 billion daily, there's efficiency gains to be made. And as it is coming from Europe, as it is flowing into Europe, you cannot use US dollar. Or you can use it, but then we say goodbye to the euro, which we most likely won't do. So we are comparing apples to, what is it, peers? When we say, you don't need the euro. Yes, if that is true, then we should all skip the euro that we have in our pockets and go for US dollar, which we won't do. If the answer to that is no, then it automatically says, but then we have to have the tokenized version of all currency, of the currency mix that we have today too, and that means e-money needs to be tokenized. That's e-money tokens, that's stablecoins, and that's the answer we needed.
Actually, from my angle, again, from my customers' angle, they do ask for your European-denominated stablecoins simply because they need to settle with us also in euro, because the payment transaction is in euro. So for them, it's a pain if they can only settle. So we offer stablecoin settlement. Originally, it was only in USDC. They didn't like it because of the FX risk. So European transactions settle stablecoins based in euro. Which I think is very fair. No, that's why I'm also looking forward to having more European stablecoins.
Absolutely.
Regarding the FX angle, so if the European assets are getting tokenized or are being, in a way, the USD denominated stablecoins are used for the European assets, and there is an inflation in the USD itself, so will there be like an imported inflation?
Okay, now the way Genius is structured right now is to refinance the US economy and not to allow for global payments. That's also the complaint from the market. So Genius is not really solving the payment issues. So in that sense, when we would be forced to use USAT, if that is now the new US dollar stablecoin, we are all forced to refinance the US economy. That's per se something we as Europeans should probably double think about it. Either we copy it to refinance the European Union, or at least we have a counter answer to that one. In that sense, yes, if we would do this. Now you can imagine a situation where, talking about tariffs, there's 100% tariffs on fiat payments, but there's 0 tariffs on USAT payments. Guess what? Everybody will use USAT. And maybe we as Europeans cannot be as bully as we've been with Russia when they try to force everybody to use ruble for gas. If you want to do business with the US, you probably have to use their payment rails. So in a sense, yes, there's the risk that they import it. Yes, there's the risk that we refinance it. And the only answer to that one is, like for like, you have to have an own stablecoin that you can use as a counterpart to the US side.
Makes sense.
Do the FX so that you're locally denominated and not bear the FX risk that you have here.
And to be fair, I would argue that the more demand there is for stablecoins, the more demand is coming out of Europe for stablecoins, the more demand there will be for euro 100%. In general. I mean, I see it with my customers. Fair enough, it mainly comes from the digital asset trading platforms, because they're the ones who have an abundance on stablecoins on their platforms and so on and so forth. But yeah, demand will pick up. Demand will people will use them more probably, and with that will come the demand for European-denominated stablecoins.
Makes sense.
100%.
Casper, you have a front row seat in Latin America, you are building an on-chain neobank in Mexico. I'm curious, like how the stablecoins are helping you with your problems.
I mean, yeah, we talked about pre-funding a little bit. So pre-funding on the weekend for settlement, and then also pre-funding generally in a collateral like escrow account, which holds a lot of capital. Like if you look at it relative to our portfolio, like how much capital we have at risk in lending, it is quite a bit of capital, and we pay interest on that. And so our net interest margin is less because we have to hold all this capital. And so yeah, if stablecoins solve that, then we will have less capital, more profitability. We can increase the access to financial services. Some other ways, I mean, we've talked about the Euro stablecoin. Local stablecoins are definitely, I think, going to be part of the evolution of sort of bringing a lot on chain, such as the Mexican peso, or in Brazil, or in Colombia, or in Peru, or in Argentina. It will probably take some time, but I do think that will also play a role, and it's going to help us too. Like if we can use digital pesos instead of using fiat pesos, then we don't have to on and off ramp, which incurs fees, and then we're less profitable. So there's definitely like an evolution to it, and I think over time more and more things will come on chain, and then that will actually incentivize other players to come on chain, which is exactly what we're doing. We're building natively the whole stack on chain, and there's reasons we're doing that, but ultimately we're doing it to compete, and we think that we can compete better if everything is on chain, and that will add some defensibility and things like that. So I think it's going to take time, but I think overall, yeah, it's a good game plan.
Interesting, interesting. And quick question on the efficiency part. How can stablecoins help free up some of the working capital in the global supply chains?
I mean, you get the money earlier. And that's it. I mean, what I find interesting is when you see stuff like the trigger solution or so, the companies invited to the trigger solution are the ones who don't need they don't have a problem. It's the tier 1 companies that anyway have the best access to payments, the best banking rails, and the best prices. Now, go level lower than that, or down the, let's say, the chain. Yeah, it's these, let's say, larger, medium-sized companies that have international business and a long-standing relation, but not with 100 banks, but with one bank. Yeah? And for them, it really makes a difference whether they get the money one day earlier. Yeah? Less risk, maybe less FX risk, and they get just the money one day earlier. And one day earlier can really mean that they can either invest it, or they get some interest, or they can directly pay their next bills. And don't forget the risk that you also take out of the system. It's not only that you get the money earlier, it's also that you have the guarantees. You can pay faster, you get the money in earlier. And that is a huge benefit. I also constantly hear, yeah, but there's no interest-bearing instrument. You know, they don't care. Honestly, a medium-sized corporate who just takes risk out of the payment flow and gets the money 2 days earlier, they don't care whether there's a 1 or 2% interest on that one. If they really want to have the interest, they can go to the house bank, redeem it against and invest it into a money market fund. What's the problem? So that is the huge benefit. And it is not, as I said, between Germany and France, but it's really when it comes to, I don't know, South Africa to Brazil. Yeah. This is where really the money is on the way, where you have a risk in the system. And I think that this is a huge opportunity actually for the classical players, if I may say so, actually to use the capabilities of stablecoins to serve their clients and bring them to this next level. And both sides actually benefit from these efficiency gains.
Maybe if I can add, I think it complements very well what I said before. No, like it's not for an HSBC or a city. No. Like the speed of settlement is not. They're fine. It's really like my customers, the fintech, like they're not investment grade customers, not the big ones. They need to have efficient financial settlement cycles because like they cannot afford posting collateral, like humongous amounts of collateral. Typically, it's an average transaction volume per day that needs to be posted for every day. That's basically not where no settlement is taking place. And so just to add a nuance to what we just said, like yes, we are a classical player, agreed, but we are looking at us and we're integrating it into our payment products as we have as well, and we're developing new payment products actually as we speak. Coming back to the number that I just mentioned before as well, like this 27.6 billion in transaction volume. First, we need to remember this is mainly just still driven by trading. Like if you compare it to MasterCard, like I've seen that the volumes have been compared to MasterCard, that does happen a lot. Our volumes are not trading volumes, no. Our volumes are domestic, international payments, but that means in MasterCard terms, I, Dorothea, use my Commerzbank card in Germany to pay for my coffee. Use my Commerzbank card in France, this is Inter, to pay for, I don't know, my croissant. Or I go to New York and pay there. This is what we call international or cross-border payments at MasterCard. This is not cross-border payments, I think, but most people understand as cross-border payments. So that, I think, is remittances or B2B transactions, like, I don't know, Siemens sends money to Kuala Lumpur or something like that. And I think there we have massive amounts of inefficiencies that still can be like fixed with stablecoins, and we see that, and I 100% agree. On the, let's say, retail or MasterCard version of payments, or domestic payments and international payments, cards have come up with this efficient solution of, I don't know, if you go to Asia Pacific, Alipay or WeChat Pay as well. But really, the pain points is in the international market money transfer. That's at least my point of view.
And you said it also, I 100% agree. It is the cutoff times.
Yeah.
A lot of banks, the cutoff time actually for the payment is like 3 o'clock. Yeah. It's not like 11 in the evening. It's like 3 o'clock. Yeah. And then whenever it comes to a weekend, you have a problem. Yeah. So for example, car fleets are financed not over the dealerships anymore. They're financed directly with the producer. Yeah. Whenever the payments are transacted at the end of the year, you have to be careful that they are not whatsoever spilling over into the next year with the bank holidays, with the public holidays and stuff like this. And a stablecoin guarantees that the payment is done 1 minute before 12. And that's a huge security risk benefit, but also efficiency benefit to that one. So when it comes to, let's say, con times, or weekends, or maybe the tier 2 global payments, not retail payments, corporate payments, there's huge benefits.
Yeah.
Super. With that, I would like to open the floor for questions from the audience. Yes, sir. Do we have a mic?
So I know the term sounds very 2021, but do you think that CBDCs, CBDCs, that's the right sequence, will become a thing again? And with that, if they ever come, will they be a threat to stablecoin issuers? And I think what makes that question especially pressing, from my view at least, is that we also learned in the last session that blockchain technology works best for digitally native assets, and cash already is, except for banknotes, is already a digitally native asset. So the leap to that is quite small indeed.
So I think there is if I may start, there is a reason why today in the classical world, allow me to say classical world, there are central bank money, there's deposit money, there's commercial bank money, and there's e-money. And just because we tokenize it doesn't make it go away. Because there's a reason today, why shouldn't there be a reason tomorrow? So there will be CBDCs, sure. There will be deposit token, there will be commercial bank money token, and there are e-money tokens. And just, as I said, tokenizing it doesn't make it not realistic or feasible or whatever have you anymore. CBDCs will not put a danger to stablecoins because they serve a different purpose. And CBDCs only work in a CBDC environment. I cannot pay my ice cream in Izmir at the beach with CBDCs. Impossible. It's impossible. Matter of fact, I can only pay with CBDCs if the receiving end is also using CBDCs. The US clearly said they won't use CBDCs. So I come with CBDCs in Europe, send the CBDCs, send somewhere, not to the US, because nobody will pick it up in the US. So there will be a market for CBDCs, 100%. And it is rightful and justifiable and everything. And then there is a use case and a market for stablecoins. And they will develop in parallel, so to say. That's at least my opinion.
Great, thanks, Alex. Any other questions from the audience? Here.
Thank you. I'm going to pose the same question I posed in the first panel, which is, Dorothea, you were mentioning, your clients are asking for a euro-backed stablecoin.
Yeah.
Like, why are you not king-making a
MasterCard issuing a stablecoin?
No, maybe not a MasterCard issued stablecoin, but for example, making sure that Alexander's stablecoin is the dominant stablecoin issuer in Europe, and it's billions of euros on the management. You're going to satisfy your clients by doing that. A transaction of that size, you probably have good terms with Alexander, right? Maybe even ownership. We see Circle, the IPO at what, 100 billion. Tether is raising at a $500 billion valuation.
Yeah.
Like, this is the opportunity in Europe, right? To generate a $100 billion company based here.
I love that question.
Excellent question. Excellent question.
We are open to onboard stablecoins in our settlement product, and that's not a problem at all. In fact, we have started only with Circle, to be fair, because they have been in Paxos, because they were our initial partners. But typically, again, on the MasterCard side, it comes with the demand from the customer. So if a customer, I don't know, like Binance or Coinbase or MetaMask comes and says, okay, please, MasterCard, we are using all Unity, we're using Monerium, we're using Schumann, we're using Euracy. That's typically how we do it. But in general, we are open to onboard any stablecoin, as long as they're compliant with regulation. Just to add the disclaimer here. Yeah, it's an important one.
Lovely. We have time for just one more question. There.
I have a question to all the panelists. If someone from the SWIFT system would be part of the panel, what would be his take on what you discussed?
That would be my question. I would have had for Swift, but Swift announced at Cybers in any case that they're planning to roll out distributed ledger technology, which that is actually a question I had in my head for the longest time. Like Swift must be thinking about this quite seriously, hopefully.
When we look at the original white paper, 2008, it was not about Bitcoin trading. It was not about a lot of stuff that we are discussing. It was about payments, cross-border payments. So what we are discussing today is actually bringing the whole blockchain discussion back to where it started. That was the original purpose. And the enemy of the past, if you want to say so, was Western Union. And Western Union, when did they announce to go into the topic? Yesterday or so?
Yeah.
So it took them quite a time to get into that topic. So SWIFT, whenever we talk to corporates or financial institutions, there's always this lingering, we want to bypass the existing model, which means SWIFT. And SWIFT, you can say, is a European model, but it's heavily influenced by the US. So there is a certain governance that is not, let's say, or could be optimized. And for them, naturally, it's preserving their status. Same for Western Union. But they're huge organizations. There's a huge governance, and very often huge organizations were very slow to react. So if Western Union would have acted 2009, we probably would not sit here together. Very easy, yeah. So I think it is time for them to move. Whether it's too late already, I would say in a certain aspects, yes. Because the ship is already sailing and it's out of the harbor, and they might cover some of the stuff back in. But I think for a lot of aspects, it will take a little bit of time because they can play the card on that one. But also on the cost side, I would say that new initiatives coming up, they start with a different efficiency. And that means, and you said it so, we can offer that at a fractional price and still be highly profitable. And that's something that a lot of incumbent institutions can cope with.
I think we've seen this in a broader scope. Maybe you mentioned clearinghouses earlier, how difficult it would have been to start a clearinghouse maybe 10 years ago, and now how much easier it is. And I think for all the incumbents, I mean, on the clearing side, you have with Euroclear and Clearstream, obviously. All these incumbents need to ask themselves how to approach this new technology, right? Because I think the awareness by now that there's a more efficient, cheaper way of doing business is there in most organizations. And the question is how to react to it, right? And what we're seeing is, I would say, mainly two approaches, right? Some try to implement a new technology, and of course they're large organizations, and a lot of them have been late to the party, but at least they're doing something now. And the answer you usually get is the answer you always get when you talk to a large organization or a bank or somebody in the financial industry. They're doing it to reduce risk, because they're saying, okay, maybe we don't believe in this, but we'd rather have it. And if everybody is really moving over and we're losing our status in the market, then we want to be ready for that, right? And others, I think, are still a bit more hesitant because they want to defend the status quo. And I think for those players, that the time will come where they probably have to pay or overpay for a solution in the market and buy it. I mean, the advantage those large players have is that they have enough capital to probably make that move when it really becomes a serious threat to their business model or when they really see it on the bottom line. But in my opinion, at least, that will be the more costly approach to take.
This is a very interesting discussion, but unfortunately, we are a bit over time. I thank you very much for such an insightful discussion. It was amazing. Thank you so much.